Good morning, everyone, and welcome to the Sirius Report. Well, it appears that the tariffs may actually be bringing and blowing up the Western financial system. This is something we're going to talk about now. Paul, as always, I want to thank you for being a part of this discussion. And I'll tell you what, not just yesterday, but today we have China's retaliation with some new tariffs themselves, and everything is just coming apart.
Yeah, thanks for joining as well. Pleasure as ever. So, yeah, we thought it will be a good time to assess what's going on in terms of markets. What does it mean? What's happening? Why is this relevant? And how does it relate to tariffs, of course? And the one thing I think is probably worth starting, or a good starting point, relates to the fact we've spoken for a long time about why de-dollarization happened, why the global south countries was getting sick and tired of sanctions, sick and tired of, in case Russia being cut off from SWIFT, freezing assets, and then tariffs is just another example of where the United States is trying to, in essence, thinks it can assert its authority, which it no longer has, trying to assert its exorbitant privilege that no longer exists. And they're not giving up on their exorbitant privilege. They're just deciding to try and play it a different way because they've realized having the exorbitant privilege and the dollar the way it was just simply no longer works. But then they've now come up with this whole new great idea that we'll threaten nations with tariffs, we'll put them on and then use it as a bargaining tool to remove them. And we're not going to get into China specifically, but China retaliated by putting 34% on US exports to China and a whole bunch of other things. But what we thought was more interesting to reflect upon, and it's something that in essence is an overarching feature of the Western financial system that transcends all the markets, and we'll go on talk about some of the markets today, so equities and oil, gold, silver, treasuries, etc. And in essence, this is the fact that what happens if foreign investment in the United States dries up? What happens if foreign investors decide to take retaliatory action and sell off dollar denominated assets? We saw, and it remains to be seen, it's early days, that the actual dollar got weaker in the last few days since Trump's so-called Liberation Day, which indicates, of course, that a lot of currencies were being bought and dollars were being sold. So if you have a weaker dollar, it then becomes a problem for dollar denominated assets. We've also seen a very sharp falls, relatively speaking, in the last few days to do with equities. Now, if you combine equities falling sharply alongside a dollar that wasn't supposed to fall sharply, but it is after the tariff announcement, then in essence, that becomes a double whammy between the markets falling and the dollar depreciating. And that can trigger, for those holding dollars, a huge sell-off in US dollar denominated assets. There is, I think, already indication, and it has been going on for a while, that that is indeed the case. Now, that could be one of the biggest, most explosive events that we've had since 2008. And that in of itself could cause a massive implosion of, and I wouldn't call it the global financial system because in 2008 it wasn't global. They said that to make Westerners believe it wasn't just our problem because of our idiotic financialization and other policies, allowing banks to run amok. This will be another Western financial system crisis. And there's a whole bunch of other problems that would result in if this was the case. But it wouldn't surprise anyone to see huge amounts of investment being pulled out of the US simply because people have looked at what's happened in Ukraine for 3 years with Russia. And also they see the tariffs as another indication of the United States trying to bully countries without putting sanctions on them, but saying, if you don't do as you're told, instead of sanctioning you, we're going to tariff you. And as we said yesterday, if you take the example, I think, of Vietnam, whose trade surplus with the United States versus, exports and imports means the United States is effectively in deficit on bilateral trade between the two countries for 90%. So the US went and put 46% tariffs on. Now, the argument is Vietnam doesn't play ball, meaning don't do as you're told, then we'll up the tariffs to 90%. So tariffs are not sanctions, but they're very similar in essence. And therefore, nations in the global south are looking at this going, well, hang on a minute, we've had enough of this. So, dollar denominated assets could start to be sold. The Chinese can sell enormous amounts, and they're not, because they apparently, I've heard this from several sources, that they own quite hefty stakes in US equities. Well, they might just start dumping all those. Maybe they already have done, because, even today, we're seeing, the Dow, for example, down over 1,300 points. Okay, it's all relative. And as you pointed out, Ken, there's still a 600% rise since 2008, but this is only the start. I mean, I'm not saying they'll wipe out 1,000 points a day, but it could continue to happen. And there's going to be ramifications as well. And if equities keep falling, the dollar keeps weakening, then there will be more and more dollar denominated assets sold off. And this market is enormous. You're talking tens of trillions of dollars. So this is something that, due to tariff policy, could indeed blow up the Western financial system. And there's a whole bunch of other reasons why, and we're going to come on to those.
Yeah, one of those in particular, and it's interesting because you and I were going to do a podcast, had set up regarding one of the foundations was the Treasury Department is actually running out of cash. Late March, Treasury cash down 480 billion, and it's less than 500 billion that it's got there. With interest rates high, the Fed in their last FOMC came out and said, we're not going to make any changes. And in fact, there was some rumors that the Fed was looking to raise rates, potentially thinking that inflation still wasn't under control. Well, desperately, the Trump administration took a look at the books, and they see that, oh my gosh, going into next year, we're going to have something like $7.8 trillion of our national debt. That's got to be rolled over. And if rates remain high, that's going to be rolled over to a point it could feasibly add $200 to $250 billion worth of interest payments to the national debt. That aside, take a look at what has happened with this big tariff announcement, Liberation Day. We have seen a sell-off in equities. We've seen a sell-off in virtually everything in the paper commodities. Most of it, when you take a look at the spot gold, spot silver, oil's down below $61 a barrel. Oh my God. These are all selling to get margins to try to sustain the equities. But what we're also seeing is a sell-off in equities and moving into treasuries, which is driving down the rates. So if this is something that the Trump administration wanted to do by bringing rates down without the Fed intervening, especially on the back end, well, you've got the 10-year below 4%, and they wanted even more. So it's, there's a lot of things around this that not necessarily are about either just trade and trade imbalances. It's not just necessarily about we need to get our corporations that have all offshored since NAFTA in 1996. We need to get them all coming back and producing inside the confines of the United States. We're actually talking about the U.S. is looking at, especially after what was done during the pandemic years, they're on the cusp of really, a monetary collapse. And if the Fed wasn't intervening, because if the Fed does intervene, we're going to see price inflation. Well, now we've got the potential, because of tariffs, to see a price inflation, at the same time a recession, so stagflation, and also asset deflation. And that whether that's gold, housing, equities, whatever, it's going to be interesting if, this is just 2 days into it, what's going to be for the long term.
Yeah, I mean, and there's a number of huge problems and contradictions. They can think we're going to reduce the yields on treasuries because we've got to roll over the debt. But there's huge problems with that, because if they're smashing equities, then that starts to create enormous problems in the corporate sector, in all, and we've said this before, but in real estate, commercial real estate, retail real estate, all the markets. Suddenly they're all going to be screaming, because everybody's always screaming for more credit. And whoever's going to obviously buy that debt is going to go, I want a much higher premium. So all the premiums will go up. And that's going to put pressure on the treasury market. So there's going to be this losing battle between them fighting to keep yields down and yields rising. And also because if they keep blowing up the entire economy, then inevitably the Fed's going to step in. It's going to be QE to infinity again. And therefore, on that basis, you can slash interest rates however you want, but you're just going to create massive inflationary pressure again, because they're going to have to step in at some point if this carried on, and we don't know, and because everything will just blow up. So equities are important. The US can't sit there and go, well, we're going to slash interest rates, but in the meantime, we're going to keep we want. I mean, this is the other thing. They say they want a weaker dollar, but they don't understand what a weaker dollar, as we just explained, will do. They also don't seem to understand that it's like a double whammy, because what they're proposing, obviously, to do is have a weaker dollar, which is going to cause inflation in imports, as well as tariffs, which create inflation on imports. So you're going to have double whammy of price inflation. That creates a huge problem. It's likely to even then result in blowing up the economy even more. This is going to impact equities. Okay, oil is a bit of an irrelevance. The US wants cheaper oil. This has been a stated mandate for years. But the problem with the cheaper oil is oil's now at $60 a barrel or so. It's getting to the point where it's a huge problem for US shale. I mean, they can't produce a barrel that's without making a loss. So, again, be careful what you wish for. They're trying to manipulate markets and think that this is all going to work out a bit swimmingly well for them by smashing the price of oil. Doesn't matter what happens to equities. Who cares about this? We're going to sort this tariff problem out. The rest of the world will acquiesce to our demands. Well, China is, and China is going to go for the jugular with them, as we said previously. And they think they can control the treasury markets, and frankly, they can't. They think on the short term they can, but what happens when the inevitable happens? And therefore, we're going to see a situation where companies' ratings start to fall. They start to move out of investment grade into junk status. Then they have to go to the junk bond markets, and then what happens when no one wants to buy the debt? What happens when huge amounts of businesses fail and the Fed will step in and go, well, we'll have to bail everything out again because we can't allow the entire economy to collapse. So, and then if you get massive unemployment and then your whole fiscal policy goes out the window, then you have the problem where your budget deficit skyrockets. You've got the Fed, who's going to be in complete opposition to what the Trump's policy ambassador wants to see happening. And it's true. There is rumors the Fed and lots of commentators are seeing inflation going at 5, 6, 7%. Well, the Fed's proper way to react to that, if they're doing their job, is to hike interest rates. So they're going to do the exact opposite to what the Trump administration wants. They're going to hike interest rate into a situation where we have huge inflation through self-inflicted tariff policies, through a decision to try and weaken the dollar, which, as I said, then plays into all these dollar-denominated assets being dumped, which is going to then impact the equity markets. And who knows, also, and we haven't even talked about the derivatives markets. Maybe we'll do that in a separate conversation because no one talks about that anymore, weirdly. And I think it's because no one understands what the derivatives markets are and what it means. But there isn't any way out of this mess. Whatever they do, they're just digging this gigantic hole. And the question is, what happens if the Fed starts to totally contradict the US Treasury? Then we're going to have a stand-up war between the two of them. And really, at the end of the day, Powell's in a situation now where whatever he does, he's damned if he does and damned if he doesn't. Doesn't matter what he does. There's no way out of this. I'm sure the Fed knows this, but the Trump administration's just living in denial and pretending that somehow this will all magically work out and they're going to hang around long enough. Believe it or not, apparently what's going to happen is they'll manage until they're going to have the AI revolution. The US is going to lead the world in it. They're going to have massive prosperity, huge amounts of jobs, etc., and that'll solve the American problem. Well, someone ought to tell those who think that just how many jobs will be lost with AI, because for every job it creates, 100 jobs will be lost or more. It will devastate the job market as it is now. So again, this is one of these situations where someone's feeding Trump an awful lot of nonsensical information. They're leading him to believe that this is a policy decision where the United States is saying, in inverted commas, oh, well, the world's changing. We acknowledge the world's changing, but they want the world to change so they become a dominant economic industrial power. The rest of the world still acquiesces to them. The US still has the dollar to drag naughty, offending countries into line. It will still be a world reserve country. They want everything, and they want their industrial base back, and they can't have either of them as things stand, because if you want one, you can't have the other, and you can't have an industrial base anyway because the United States can't afford to do this. And also the dollar's toast anyway, as far as being a world reserve currency, because the world's going to continue to de-dollarize precisely because of things like the US tariff policy.
You know, there are times in history where there is a force majeure that comes out of nowhere overnight and creates change or wreaks havoc. But more often than not, you need to go back to 2008. In 2007, we were starting to see the end of the housing bubble. Everything that led up to it, the collapse of the different banks, the investment banks, the stock market crash in October of that year. There were signals that were pointing to this if anybody really wanted to see. I was reminded this morning of 3 different signals that have come out. One, the alleged greatest investor of all time, Warren Buffett. He went into cash completely, just dislocated himself from most equities, and has been sitting on cash for probably at least a quarter now. And he was getting vilified and crucified by the business analysts. Oh, how could you do this? When we got these wonderful Mag 7 stocks and whatever. And he just sat and he didn't respond. And yet he's sitting here looking like a genius because he did that. Well, also back in March of this year, late March 27th in particular, all of a sudden there were this news story popping up on the business media that the Fed is being urged to start setting up tools to bail out hedge funds. Well, the equity markets were sitting there at near all-time highs. Why would we have to worry about hedge funds going under? And then, of course, we have the other thing where Trump, since he came in office, has been saying, I don't care about the stock market. I don't care about the stock market. Pretty much signaling that the policies he's going to imply are more general towards the economy and towards the debt than they are about stocks. So you see a lot of signals out there of the direction that his fiscal policies were going to go. And you see some of the responses that even the Fed knew that if they were implemented, this big tariff thing, and it's not like the tariff thing came overnight. Trump's been playing the tariff game since he got into office in January. God, it's hard to believe it's only been barely over 2 months, and the chaos that has reigned since that time. So, with that being said, it should not be surprising because this can has been kicked, not just going back to 2008. It's been kicked since 2001. And any little change can cause trillions of dollars overnight. Boom, boom, boom.
Yeah, absolutely. And one of the big problems with all this is people often don't understand the difference between paper markets and physical markets. There is no way the price of oil is moved because down to $60 a barrel because, well, it's partly because no doubt fueled by an idea we're going to have a global recession, meaning a Western recession and a Western financial crisis. But it's also been manipulated lower because the United States wants lower oil prices. Trump says he doesn't care about equities, but in the next breath, he will care about equities when the price keeps falling and falling, and the risk is that will happen. We'll see what happens. With regards to gold and silver, the paper prices are irrelevant because huge sums of or quantities of physical gold and silver still going to the United States as one example in all over the world. So this is just a paper smash. It also, though, of course, brings into question a lot of theories people have had in recent times with regards to what's been going on in the gold markets. That's a whole separate discussion, and I wish it was a lot more popular and of interest to people. For some reason, when we discuss it, people don't think it's interesting, even though we've been the only people right about the gold and silver markets for over 10 years. But anyway, that's a separate point. But the silver price was manipulated down to such an extent that it basically nearly went into backwardation, which implies in backwardation there's such a demand for silver that people will pay more now to get their hands on silver than they will do in the futures market. Well, if the price gets smashed over 10%, why would there be such a massive demand? Well, the massive demand comes about because there's a huge disconnect between reality, which is the physical markets, and the illusion, which is the paper market. So you always have to be careful about what's going on in gold and oil. But I think the equities has significance. I think the Treasury markets clearly has significance. And there are certain things worth paying attention to more than other. But at the end of the day, there is this whole issue of dollar-denominated assets being dumped. Treasuries could be dumped heavily. The Chinese could go full bore and dump hundreds of billions of them, potentially. So there are a lot of factors in play, but the idea that these tariff policies are somehow going to allow the United States to reindustrialize, the rest of the world's going to acquiesce, and there's no damage with regards to the Western financial system is sadly very much foolish to believe that to be the case.
Yeah, and we've been touching on the surface here, taking a look at just things from going on in the equities and the Treasury, the yields, et cetera. If this extends beyond a few days or a week, or we've already had obviously China retaliate, and then we had Trump come out and make threats about what China did. If that continues on for any extended period of time, now all of a sudden we're taking a look into the derivatives market or the global currency carry trade that is a complex thing unto itself. So for right now, it's the surface markets that are being affected, but the amount of underlying derivatives in this that tie this whole thing together. I mean, it was, I think at the beginning or late, yeah, maybe about middle of March, somebody made a point that the global debt was up to 350 trillion dollars. Something has to give. And if it's not a matter of nations being willing to deal with it, then nature itself, or as they say, a return to the mean, is going to take place. And I think we see this with the dollar. When Trump instituted the tariffs, the dollar should have gone up or at least remained the same. And it took a big dump. So there's something that's tied to the dollar that was pulling it down in opposition to what his policy was. And from there, who knows what other derivatives are being, have an intrinsic pull on the Western and especially the US financial system.
Yeah, absolutely. And I've got a final point to make because literally someone's just sent me a quote from Trump, and I think this beautifully encapsulates what we're just talking about. He said, this would be a perfect time for Fed Chairman Powell to cut interest rates. He's always late, but he could now change his image and quickly. Energy prices are down, interest rates are down, inflation is down. He says even eggs are down 69%, and jobs are up all within 2 months. A big win for America. Cut interest rates, Jerome, and stop playing politics. Well, that tells you everything about what's been going on. Because after what, 2 days saying energy prices are down? Well, how's that come about? Well, it's total manipulation. Interest rates, they're not really down. Okay, you've got the 10-year below 4%. Inflation's down. No, it isn't. Don't know about egg prices in the US, don't live there. And jobs, well, some of the jobs data I've seen is the exact opposite. What we've been seeing is jobs, well, more unemployment. We're seeing cuts in terms of service activity, cuts in terms of inventory, everything indicating stagflation. Inflation up, so because prices are up for producing goods. So this shows what is underpinning all this nonsense that's going on. And, Powell's not going to pay any attention to that. But you can see in part why they're putting this tariff in place, policy in place. And it could be at the end of the day, this gigantic bluff, and they're hoping other countries will actually concede because they're terrified what it will mean. The Chinese won't. So, if other countries say, we're not going to acquiesce, then the US has to carry on, because if Trump walks away from the tariffs, he looks weak and ineffectual. So they're digging themselves a gigantic hole. They're not going to get out of it very easily. And the fact of telegraphing those comments to Powell speaks volumes.
Absolutely. Paul, I think that's a good place to call it a day.
Yeah.
I want to thank you as always for your insight and for being a part of the discussion.
Yeah, and likewise.
And everybody here at the Sirius Report community, thank you for all of your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it might be important to. And until the next time we get together, have a great day.